I ever show you this? These are called non-qualified mortgages. The difference between non-qualified mortgages and other loans is simply whether or not they qualify for what's known as the Safe Harbor Act, which is a law, part of Dodd-Frank. And agency loans, which I'm going to get into on the board, are qualified mortgages. Non-qualified mortgages is everything else. HELOCs, second mortgages would be non-qualified mortgages. FHA loans, VA loans, USDA loans, loans that are sold to Fannie Mae or Freddie Mac would be qualified mortgages. And all it really means is that they qualify for Safe Harbor, which allows the lender to foreclose easier terms if you, the borrower, do not make your payments. So what we're going to talk about today is non-qualified mortgages. We offer a whole series of non-qualified mortgages for borrowers who are self-employed or investors. And that's what I want to talk to you about today. So I'm going to go to the board and I'm going to break it down, just some basics. Okay, we're going to start with just some basics. So let's talk about this for a second. So qualified, we're going to start with qualified mortgages. Okay, qualified mortgages would be agency loans, would be qualified, and they consist on loans that are sold to Fannie Mae, Freddie Mac, FHA, VA, USDA. These would be agency loans. Those are the 5 agencies: Fannie, Freddie, FHA, VA, USDA. Everything else is non-qualified mortgages. And that's what we're going to talk about today. Non-QM loans. A non-qualified mortgage is every loan that is not a qualified mortgage that's an agency loan. Okay, so let's get into it. The Fannie Mae threshold is set by the FHFA, which is the Federal Housing Finance Agency. This is a government agency that every year sets the threshold for the maximum loan limit, and every county is different. I believe right now today the highest county loan limit for Southern California, for example, I believe is like $1,078,000. I have to check, but we'll look on that. And that just means if your loan amount is up to that dollar amount and you meet all of the other requirements to make the loan eligible for Fannie Mae, it is an agency loan. And if it is a $1 over that, it is a non-qualified mortgage. If it is loans that are interest only, those are non-qualified mortgages. If it is loans that have a prepayment penalty, which differs in every state, every program, those are non-qualified mortgage. If it's loans with a balloon payment, those are non-qualified mortgages. And if it's loans with alternate forms of income documentation, those are non-qualified mortgages. What do I mean by alternate forms of income documentation? Let's say you're self-employed and you've been self-employed for years and you don't make enough on your tax returns because you have too many write-offs and business expenses. We would use your bank statement deposits for up to 12 months, as much as 24 months. We'll add up all of your deposits, and if you own 100% of the business, there will be an expense factor applied to your deposits in a 12-month period on your bank account. And let's say your business runs at a 30% expense, right? And your deposits are $100,000 a month. That would be 1.2 million times 70%, which is $840,000. We would use that $840,000 number divide by 12, we would get $70,000 a month. And we would use that income figure to qualify you. That's the number that we would use to qualify for a mortgage. That would be an alternate form of income documentation. A loan with a prepayment penalty would only be on an investment property, and it would not be a loan that's eligible to sell to the agency. It would be a non-qualified mortgage. You would have a prepayment penalty up to 5 years. The dollar amount depends on the loan amount and where we're selling the loan, this type of loan. An interest-only loan would be a loan with no principal. It doesn't mean you can't pay principal. You certainly can pay principal. The principal is up to you. You can pay as little as $1 principal, as much as you want. And of course, the loan limit, if it's none of these three here, it's not interest only, but it is $1 over this Fannie Mae or Freddie Mac loan limit, it is considered a non-qualified mortgage. We would sell those loans. I've been making those loans for 25 years. We would sell those loans to an insurance company. Okay? So, these type of loans are targeted for higher cost areas, such as Southern California, because the prices of real estate are so high. So pretty much 70% of the loans in Southern California are over the Fannie Mae threshold because the purchase prices are just so ridiculously high. I don't know if it's 70%, but I'm in Orange County. It feels like it's 70%, right? Okay, so that's a non-qualified mortgage. I think what we need to get into is I need to go back to some basics, okay? So let's talk about this for a second. So what is, how do you qualify for a loan, right? We're going to come back to non-qualified mortgages. Let's talk about how do you qualify for a loan.